Okay, so we have housing starts on the rise. We have record high income inequality, which makes it practically impossible for many Canadians to even dream of ever owning a home. The latest data from Canada Mortgage and Housing Corporation, CMHC, is in. It shows that there is a slight uptick in the pace of housing starts for the month of September. Let's break down the story behind these numbers here. The CMHC reports a 5% increase in housing starts compared to August, with the seasonally adjusted annual rate reaching 223,808 units. That's up from 213,012 in August. Now, that might seem like a positive sign, that rise there, but we're going to dive a little bit deeper to see what this really means and how it fits into the broader picture. The September report shows a notable increase in urban centers. Housing starts climbed by 6%, reaching 210,002 units. When we zoom in on the first 9 months of 2024, we can see the actual housing starts in urban centers were up 2% compared to the same period last year. Now, specifically, 168,897 homes have begun construction in this year. That's up from the 165,559 that we saw back in 2023. Now, Montreal really stands out in this report. We see a 15% increase in year-to-date housing starts, and this strong recovery follows a sluggish 2023 when new home construction hit actually historical lows. Now, on the flip side, we're seeing a bit of a cooling in Vancouver and Toronto. Vancouver's starts are down 19%, while Toronto's have dropped 20% compared to last year, which was a record year for both of those cities. So let's break this down now by region and by type. The report highlights regional trends across Canada. Alberta, Quebec, and the Atlantic provinces are driving growth in both multi-unit and single-detached home starts. Meanwhile, Ontario, British Columbia, which are two obviously of the biggest markets, we're seeing decreases across the board there. For urban multi-unit projects like condos, apartments, townhouses, the pace of starts rose 6%, hitting 163,400 units in September. Single detached homes in urban areas also saw an increase, 5%, 46,602 starts there. Now, in rural areas, the rate of housing starts for September was estimated at 13,806 units. So when you put all this together, what does it mean for the housing market? While the numbers do show some growth here, CMHC's Deputy Chief Economist, Kevin Hughes, he emphasized that despite the bump in these housing starts, the numbers are still falling short of what is needed to tackle Canada's housing affordability crisis. Especially in urban cities, supply continues to lag behind demand, and this means that the gains here might not be enough to make a meaningful dent in the housing prices. What can we expect moving forward? Well, I guess that's the big question here. We see these housing starts in Ontario, British Columbia, they're declining. There's a growing concern about whether enough houses are even being built to meet demand. This, of course, then could influence future housing policies. It could even spark debates about further incentives for builders, especially in our urban hubs. Oh, by the way, the overall 6-month moving average for housing starts also dipped slightly from 246,972 in August to 243,759 in September. What's clear to me here is that there is movement in the right direction, but this road that we're going to have to any significant, meaningful improvement in both availability and affordability, that road is still long. It is great to see the housing starts picking up in September, but will this be enough to actually address the housing crunch in Canada's major cities? Time will tell. What do you think? I think it won't. Let me know what your thoughts are in the comments. Are we seeing a fixed income opportunity amid the rate cuts? The US Fed cut interest rates by 50 points in September. As short-term rates decline, investors are moving from cash products into equities and covered call ETFs for higher income. Now, in this climate, long-term treasury bonds have historically performed well. I'd like to introduce you to the Harvest Premium Yield Treasury ETF, HPYT, on the TSX. And this fund offers access to long-term US Treasury bonds and an enhanced yield through Harvest Trusted Active Covered Call strategy. HPYT is the largest yielding covered call fixed income ETF in Canada. It had a 16.1% yield that's annualized as of September 30th, 2024. The fund has paid out a monthly distribution of 15 cents per unit since its inception. That works out to $1.80 total distributions per unit over that period. HPYT is now the largest covered call fixed income ETF in Canada at over $500 million AUM, again, as of September 30th, 2024. So like I say, interest rates are expected to come down. This is a fund that you probably should have a look at. You can learn more at harvestetfs.com. I'll put a link in the description of this video. Stats Canada has just reported some pretty depressing news. Income inequality in Canada has now hit its highest level since record keeping even began. So what is driving this gap? What does it mean for everyday Canadians? Let's have a look at that. In the second quarter of 2024, the gap between the richest 40% of Canadians and the bottom 40%, that widened to 47 percentage points. And this is, like I say, the largest gap ever recorded since Stats Canada started tracking this back in 1999. Now, a big part of this growing divide is driven by the top 20% of earners who've increased their share of disposable income, largely thanks to significant investment gains. So you've got to wonder, what is behind this? Well, it turns out that higher interest rates are playing a major role in what we're seeing here. As interest rates have risen, borrowing costs go up, but so do returns on investments and savings. The problem here is that lower income households, they have far fewer resources to invest. That means that they can't benefit from the higher yields in the same way that wealthier Canadians can. So the top 20% of Canadians now control more than 2/3 of the country's wealth, an average of $3.4 million per household. You compare that to the bottom 40%, who only account for, get this, 2.8% of our country's wealth. In terms of income, the lowest 20% did see a small bump in their disposable income, mostly due to wage growth, but it was nowhere near enough to close the gap. The middle 60% of Canadians, often considered the heart of the middle class, they actually saw their share of disposable income go down. So at the end of the day, what does this mean for Canadians? Well, the growing income gap, this has some serious implications, especially when it comes to things like social mobility, economic opportunity. If more wealth is concentrated in fewer hands, it becomes increasingly more difficult for lower or middle income Canadians to get ahead. We'd look at things like high housing costs. Other factors are already making it harder for many Canadians to make ends meet, and this latest report just adds to that challenge. Now, naturally, when something like this happens, it's going to spark a political debate. Let's go into the trenches here for just a minute. First off, Finance Minister Chrystia Freeland, she says that the government is working hard to combat this income inequality through policies like childcare and dental programs, which are aimed at supporting middle and lower income Canadians. She pointed out that the government is actively trying to lean against the global trend of rising inequality. At a recent press conference, this is what she had to say. We are working very, very hard to lean against this tendency in the global economy towards more inequality. We're leaning against it with very specific policies designed to support middle-class Canadians and people working hard to join the middle class. Now, on the other hand, you have Conservative leader Pierre Poilievre. He had a different take on it. He argues that the Liberal policies, including what he calls the NDP Liberal money printing, he says today Stats Canada reported that the gap between the rich and the poor is at the highest level in recorded history after NDP Liberal money printing inflated the assets of the super rich while inflating the cost of living for everyone else. Gee, I wonder if we might have a federal election looming over the next 12 months or so. So what can we expect moving forward? Well, with interest rates continuing to sort of boost the wealth of the top earners, inflation, even though it's starting to come down, it's still a persistent issue. If you don't believe me, just watch the comments or read the comments in the last video I did a couple of days ago. Income inequality will continue to rise unless there are significant policy changes that are made. Programs aimed at helping lower income Canadians. I'm not so convinced they're going to provide much relief. They might provide some, but the question remains, will it be enough? I say no. The latest U.S. retail sales report for September 2024 is in. It shows a stronger than expected 0.4% increase, which is well above August's 0.1% rise. And importantly here, it beat the market expectations of 0.3%. Let's look at what's driving this growth here. The biggest winners were miscellaneous store retailers. They saw a 4% jump in sales. That was followed by clothing, 1.5%, health and personal care, 1.1%, and food and beverages, up 1%. It wasn't all positive though. This is where it gets interesting here. Electronics and appliance stores, they saw a pretty sharp 3.3% decline. Sales at gasoline stations were down 1.6%, and furniture stores also fell, down 1.4%. Sales in auto dealers was flat, and that reflects a potential cooling in car purchases. I certainly see a conflict developing right now in our consumer patterns. When you see this rise in clothing and personal care, that could be a pretty strong sign there that there is stronger consumer confidence, possibly due to back to school shopping. But the dip in electronics and gas, that to me sort of shouts out that the consumers are scaling back on discretionary spending, probably because of the higher interest rates that we're still seeing out there. A key takeaway is that the core retail sales, which exclude autos, food services, gas, they were up 0.7%. That's the most in 3 months. That again, that shows strong consumer spending. That is a crucial factor when you look at GDP growth. The big question is, will this momentum hold? Leave your thoughts in the comments below. That's a wrap for today's program. As always, thank you for watching. We'll see you in the next video.